Welcome, everyone, to the Man in Search of Gold podcast. I'm your host, Eric Mangold, and I'm the founder of Argosy Wealth Management. This is the show where we share ideas, strategies, and history to help you improve your life one financial move at a time. Let's get started. Well, welcome everybody back to the Man in Search of Gold podcast. This is episode 2. It's actually a little bit of a detour that I was going to do for episode 2. Oh, but that's okay. And thank you for everybody that listened. It was the last one I released was episode 1. And I had some listeners. I had some people listen. So if you checked it out and you listened and you liked it, thank you very much. More to come. But also hopefully it'll be good information for you that you can use for your own financial health. So thank you for everybody listening. The detour that I was going to take today is based upon some of the recent market volatility that we've seen in the stock market. And a lot of people are concerned. And I want to break that down a little bit and talk about some of the things that I've been talking to with my clients, but also some philosophical things when it comes to the market. So let's get started. So episode 2 of Man in Search of Gold podcast, here we go. Okay. So the detour is today we're going to talk about market volatility. And given recent market conditions and market events, okay, I thought it was important to talk about this because sometimes people don't talk about this, and sometimes they don't hear about this. And especially if you're going to TV or the internet, they're going to give you more fear-based tactics than really what's going on. Okay. So let's talk about the recent market volatility. The first thing is that we have to understand the markets don't always just go up. They don't always go up. They don't move in just straight lines. Okay. They don't go like this all the time. They don't go like this all the time. They certainly don't go like this all the time. Okay. It's more of a road. It's more of a twisty road than it is a straight line. So the markets don't always go up. One of the components of that is that they've done a lot of analysis, and the average investor's memory span goes about 6 months, meaning they only remember the market conditions up to and about 6 months ago. So anything that happened a year ago or 2 years ago is in the distant past. So things like the internet bubble, 2008, the market volatility we saw with COVID, most people don't really remember that unless you really remind them. Oh yeah, COVID, the market was really crazy then. Oh yeah, 2008. So those are the types of things that people just don't remember when they're investing today, because they're focused on today. It's more of a short-term based memory. So with that can be concerning when the markets become volatile like they've been in the last couple of weeks. The point I'm trying to make is that market volatility is common, and sometimes it's actually a bit welcome. And I hesitate almost by saying that, because if you get your statement and you see that your 401k statement and the market went down and your balance went down, like, what do you mean the market volatility is welcome? What are you, nuts? What I mean by that is that the market volatility being welcome is sometimes it needs to flush things out of the system, almost like plumbing does. Things need to get flushed out so we can kind of come back into a level playing field of some things. Okay, so sometimes it is a bit welcome. I didn't say it is always welcome. Sometimes it's a bit welcome. Also, we have to understand that usually the volatility is short-term. The volatility is short-term, not long-term. Okay, so if we believe that the volatility is something that's short-term based, we have to keep our long-term goals in mind, right? So that way, if we're keeping our long-term goals in mind, we're able to handle and digest some of these short-term bumps in the road. Okay. What we also have to understand is that the market in general doesn't like uncertainty. It doesn't like things like tariffs and trade wars, political tension. And now this is not going to be a political podcast. No way. Okay. Because you could go to each side of the aisle and you're going to hear, fear type tactics. Okay. But the market doesn't like uncertainty. What's going to happen with the trade issues and trade wars? To be determined, right? Political tension. Okay. Global conflicts, because we have the war in Ukraine, we have the Middle East, rising tensions. So the market does not like uncertainty. And typically when there is uncertainty in the globe or geopolitical events, then the market will react negatively to that. So that's part of things too. The market doesn't like uncertainty. Let's break down something that is probably one of the bigger mistakes an investor can make. And that's called timing the market. What does that mean? Timing the market is when you're trying to take your money out of the stock market before it goes down. And it's also trying to put your money into the stock market before it starts rebounding and going back up. Now, numerous studies and data points have been pulled on people trying to time the market. And it's been proven time and again that this is notoriously hard for the experts. So one of the issues with timing the market is that you don't only have to make one great decision, you got to make two. Okay. The first great decision you need to make is, when are you going to pull your money out? Then you have to decide, okay, when am I going to put my money back in? So it's not one great decision you need to make and be right on. It's two great decisions you need to make and be right on. So that makes it even harder. And again, it's been proven to be notoriously hard, even for the PhDs and economists. Okay. So if we're also trying to time the market, let's factor in, is emotion playing into the decision-making process? And we've all known that, and we've probably all been there in life, that when you make decisions based solely on emotion, most times they tend not to be the best decisions for you, right? We've all can probably attest to that. Well, I'm going to get to the emotional component of this in a second, but let's talk about an example. Let's talk about an example of timing the market. So over the last 25 years, if you were invested in something like the S&P 500 over the last 25 years, and you just kept your money there, didn't take your money out, you kind of rode the volatility up and down, your rate of return over that period of time would be about 7.7%. That's not too shabby. And frankly, it's realistic, because when we're talking with our clients, we get great returns some years, but we want to we want to have consistent averages over the long term. We don't want a 20-point upswing one year and a 20-point downswing the next year. Okay, so 7.7 rate of return is pretty good. Let's level set on that. It's pretty good. But take that example. S&P 500 invested for every single day over 25 years. Okay, that's 6,625 days. If you took your money out of the market for just 10 of the best days out of those 6,625 days, your rate of return would be cut by more than half. Let me say that again. You're invested for 25 years. If you kept your money in the S&P 500 for 25 years, your rate of return would be about 7.7%. But if you took your money out and you missed only the 10 best days in that 25-year period, your rate of return will be cut by more than half. That's massive. That's massive. Okay. Now think about it. There's always going to be a reason we can find to sell, reason we can find to get out of the market. And the internet bubble, 2008, the global pandemic, terror attacks. Again, there's always going to be noise. And again, I'm not getting political. I don't care what side of the political aisle you sit on. Wherever you're getting your news, there's going to be some fear tactics. Again, they do that because that keeps your eyeballs glued to them for longer. And if it's on the internet, it's driving ad revenue. Okay. So this is one of the reasons why I'm doing this, to give you some unbiased and unemotional information on market volatility and hopefully being able to handle it. Okay. So let's go back into emotion and decisions. Okay. And I'm going to read this quote here from a famous American economist, Benjamin Graham. The investor's chief problem, and even his worst enemy, is likely to be himself. Chief problem, and often his worst enemy, is likely to be himself. What is he getting at by that? What he means is that investors tend to pull money out of the markets and put money in at the wrong times, or not at the best times. He is also meaning that investors tend to make decisions based upon emotion. Again, when we're making decisions, any life decisions, if we go on a little tangent, any life decisions, if they're made only based upon emotion, are they really the best decisions for us? I think we all have been there. We could say, I really made an emotional decision there. And if I had a do-over there, I probably would have made a different decision. The average investor underperforms the market average over the course of 25 years because they take money out and put money in at the wrong times. Okay. So let's break this down into really understanding market volatility. If we're really going to understand market volatility, we have to understand, what are your goals? Is retirement right around the corner? Is retirement 20 years from now? Where are you in your financial journey? Where are you on track to reach your financial goals? Can your portfolio handle some of the market volatility? If there's a longer runway before you're trying to reach a goal, theoretically, it could handle a little more volatility. Okay. So how long is your runway? What are your financial goals? Now, what I'm not suggesting that you take every downturn in the market and just take it on the chin like a boxer. Right? Not saying that, because each one of us has our own risk tolerance, our own appetite for risk, our own appetite for volatility. And that's something that I can't answer for you, but you have to say, where am I in my financial journey? Where am I in my financial journey? What are my goals? Can I handle some of this volatility, or can I not handle some of this volatility? And if you can't trust yourself, right? If you can't trust yourself, or if you want to talk to somebody that's going to give you unbiased advice, employ somebody like me, employ a financial advisor, talk to a financial professional and say, listen, I'm really concerned about the market volatility. Here's where I am in my portfolio. Can I talk to you for a little bit about this? And, I talk to people all the time with no obligation to say, I'll have a conversation with you, whether we decide to become clients and that get into a client advisor relationship or not. But I'm happy to listen to people's concerns because that's part of the issue. What a financial professional should be doing for you is giving you unbiased, unemotional advice that's helping you get on track or be on track or stay on track to reaching your financial summit. And that is one of the big things that financial advisors do. Yes, we do investment management, insurance planning, long-term care planning. We do all of those things. But I can't tell you how many conversations that I've had over the past couple of weeks during this market volatility. Clients just want to hear and be made felt like, okay, where are we in our journey and are we still on the right track? If we're not on the right track, then we need to do some course correction. But if we are on the right track and we can handle some of the volatility, then we're going to do that. Okay. So this was a pretty short podcast, hopefully a little short and sweet. Okay. But I want you to understand that market volatility is something that's very common. It's very common. It's not awesome when it hits, but it's very common. It also can be useful, but it's really helping you to make what my goal was is to help you understand. Try not to make emotional decisions, especially when you see the market going up and down and up and down. Try not to make emotional decisions. And if you're having a tough time with that, employ a financial professional. Talk to somebody like me who can really help sit down and hear what's going on in your world and help devise a plan or even stick with the plan that you currently have. So, Man in Search of Gold podcast, episode 2. It'll be on Spotify and YouTube. I hope you like it. But when we're talking about financial planning, for your financial planning, your financial journey, remember the time to have the map is before you enter the woods. Thanks very much. I hope you enjoyed the show. Okay, so this is to keep the legal and compliance folks happy. This is a little bit of a disclosure here. This podcast is intended to be educational and is not an offer or solicitation to purchase or sell any security or employ a specific investment strategy. It is not designed for or individually tailored to any particular investor and is not intended to be suitable or in the best interest of all types of investors. This material has been obtained from sources which we believe to be reliable, but we do not warrant or guarantee the timeliness or accuracy of this information. Opinions expressed in this video are subject to change without notice. There is no guarantee that any forecast made will be realized. Summit Financial LLC is a registered investment advisor doing business as Argosy Wealth Management, offering investment advisory and financial planning services. Summit does not provide tax or legal advice. If you require such advice, you should contact the appropriate tax or legal advisor. Past performance is not a guarantee of future results. Investing involves risks, including possible loss of principal. Thank you. I do have to add one additional disclosure. The index referenced in the example of missing the best days in market performance is the S&P 500, which shows total returns and assumes dividends are reinvested back into the index. The returns are the result of certain market factors and events for the time period noted and may not be repeated in the future. Thanks.